Hello everyone, I'm Asian Guy. There is a slow-moving structural shift taking place beneath the global economy, especially in the United States, and it revolves around something most people still treat as a success story: economic stability achieved through permanent intervention. For more than a decade, markets have been calmer than history would suggest they should be. Recessions have been shorter, financial crises have been contained, asset prices have recovered faster than underlying fundamentals. And because nothing has visibly broken, most people assume the system is healthier than ever. But this apparent stability carries hidden costs that compound quietly over time, and those costs are beginning to reshape the foundations of the economic system itself. What makes this development dangerous is not that it produces immediate chaos, it's that it changes incentives, erodes institutional discipline, and slowly rewires expectations across governments, markets, and society. And because these changes happen gradually, without a dramatic moment of failure, they remain largely invisible until the system becomes far more fragile than it appears. Before we go further, subscribe right now, because what you're about to hear explains a shift most people still haven't noticed. Let me walk you through this. Over the last several decades, and especially since the global financial crisis, economic stability has increasingly depended on continuous policy support. Central banks have moved from being backstops to being permanent participants. Fiscal authorities have moved from counter-cyclical intervention to structural dependence on deficits. Markets, in turn, have adapted to this environment, pricing assets not on underlying cash flows or productivity growth, but on the expectation that instability will always be managed, deferred, or absorbed by institutions. At the surface level, this looks like progress. Fewer collapses, less volatility, more predictable outcomes. But look closely at what's happening beneath that surface. Stability achieved through constant intervention does not eliminate risk. It redistributes it across time and institutions. Instead of frequent small corrections, you get long periods of apparent calm accompanied by rising leverage, falling resilience, and growing reliance on policy credibility. Now notice what changed. Historically, economic systems relied on failure as a corrective mechanism. Poorly allocated capital was written down, unproductive firms exited, excess debt was cleared through defaults or restructuring. These processes were painful, but they enforced discipline. They limited the accumulation of imbalances. Today, many of those corrective mechanisms have been softened or postponed. Losses are socialized, liquidity replaces solvency. Time becomes the primary policy tool. This pattern has appeared before. When institutions prioritize stability above all else, they often suppress short-term volatility at the cost of long-term adaptability. The system becomes smoother on the surface and more brittle underneath. You can see this in rising debt to GDP ratios that never return to prior baselines. You can see it in declining productivity growth despite record levels of financial activity. You can see it in asset markets that respond more to policy signals than to economic fundamentals. But this is where it becomes important. Permanent intervention changes behavior. Governments borrow more because financing appears cheap and manageable. Corporations lever up because refinancing risk feels contained. Investors move further out the risk spectrum because downside volatility seems capped. And central banks find themselves trapped by their own credibility, unable to withdraw support without triggering the very instability they are meant to prevent. This creates a feedback loop. The more stability policy delivers, the more the system relies on it. Now, the more the system relies on it, the higher the cost of withdrawal. Over time, policy tools lose optionality. Interest rates become less about managing inflation and more about sustaining balance sheets. Fiscal expansion becomes less about stimulus and more about maintenance. Institutional independence erodes not through political capture, but through structural necessity. At this stage, the risks are not obvious to most people because everyday life still functions. Employment exists, credit flows, markets open every morning. But beneath that normalcy, the economic framework becomes increasingly constrained. There are fewer buffers, less tolerance for shocks, narrower margins for error. What we are witnessing is not a crisis, but a transformation. Stability itself has become a policy objective rather than an outcome. And when stability is engineered rather than earned, it carries a price that does not show up immediately in growth numbers or market indices. It shows up in declining flexibility, weakened incentives, and institutions that can no longer afford to allow failure. This is the hidden cost. Not collapse, but gradual loss of resilience. Not panic, but dependence. And understanding that distinction is essential to understanding where the system truly stands today. As these dynamics deepen, the question is no longer whether intervention works in the short term. Clearly, it does. The real question is, what kind of system emerges when intervention becomes permanent rather than exceptional? To understand that, you have to stop looking at policy announcements and start observing institutional behavior over time. Look closely at central banks. Their original mandate was narrow: price stability, financial stability as a secondary concern, and independence from fiscal authorities. Today, those lines are blurred. Balance sheets have expanded dramatically and never meaningfully contracted. Emergency tools have become standing facilities. Forward guidance has shifted from conditional signaling to expectation management. These institutions are no longer just responding to the economy. They are embedded within it. This matters because credibility has limits. Monetary authority relies on trust, not force. When markets and governments begin to assume that central banks must always act to preserve stability, credibility quietly shifts into obligation. Policy choices narrow. Inflation becomes harder to control, not because institutions don't understand it, but because controlling it imposes costs the system is no longer structured to absorb. Now widen the lens. Fiscal policy follows a similar path. Deficits are no longer framed as temporary responses to downturns. They are normalized as tools for maintaining growth, social stability, and asset prices. Debt accumulates not because of one-off emergencies, but because rolling it forward is easier than confronting the trade-offs required to reduce it. Over time, debt sustainability becomes a function of low rates rather than productive capacity. This is a subtle but critical inversion. Instead of growth supporting debt, debt requires growth to remain manageable. That shifts political incentives. Structural reform becomes risky. Productivity-enhancing changes that cause short-term disruption are avoided. Redistribution becomes easier than expansion. The economy grows more dependent on financial engineering and less on real output gains. And this feeds directly into capital allocation. When failure is suppressed, capital does not flow to its most productive use. It flows to where it is safest under policy protection. Firms that would otherwise exit survive through cheap credit. Innovation slows not because technology disappears, but because competitive pressure weakens. The economy becomes crowded with entities that persist without contributing proportionally to growth. This is not stagnation in the dramatic sense. It's stagnation masked by liquidity. Activity continues, transactions occur, but the underlying engine loses efficiency. Over time, more resources are required to generate the same output. And because intervention keeps the system functioning, this inefficiency is tolerated far longer than it would have been in previous cycles. Now consider the psychological layer. Investors, households, and policymakers adapt their expectations. Risk perception changes. The idea of loss becomes abstract. Volatility is treated as an anomaly rather than a feature. This shifts behavior in ways that are rational individually but destabilizing collectively. Leverage rises, duration risk increases, confidence becomes asymmetric, strong on the upside and fragile on the downside. At the institutional level, legitimacy begins to erode quietly. When outcomes depend heavily on intervention, public trust becomes conditional. Success is attributed to policy competence. Failure is attributed to institutional betrayal. This asymmetry places enormous pressure on decision makers to maintain appearances, even when underlying conditions deteriorate. This pattern has historical precedent. Systems that prioritize continuity over correction often appear strong right up until adaptability fails. The breakdown, when it comes, is rarely caused by a single shock. It's triggered by the accumulation of constraints. Too much debt to raise rates, too much leverage to allow repricing, too much dependence to permit withdrawal. But this analysis is not about forecasting collapse. It's about understanding limits. Permanent intervention can delay consequences, but it cannot eliminate trade-offs. Every system eventually confronts the costs it has deferred. And the longer those costs are postponed, the more they concentrate within institutions tasked with maintaining stability. What often goes unexamined is how this environment reshapes time itself inside the economic system. When intervention is permanent, the future is continually pulled into the present. Growth is borrowed forward. Stability is purchased today by narrowing tomorrow's choices. T compresses the planning horizon of institutions that were originally designed to think in decades. You can see this in how policy debates are framed. The question is no longer whether an intervention creates distortions, but whether the system can tolerate the absence of it. That is a meaningful shift. It implies that markets, governments, and even households are no longer optimizing for durability. They are optimizing for survivability within a managed environment, and survivability is a lower standard than resilience. A resilient system absorbs shocks and adapts. A survival system simply avoids failure for as long as possible. The difference matters because adaptation requires friction. It requires loss. It requires reallocation. Permanent intervention minimizes those forces, and in doing so, it slowly undermines the system's ability to regenerate itself. This also changes how shocks are interpreted when they occur. In a system accustomed to intervention, any disruption is immediately framed as a policy failure rather than a structural signal. That reduces tolerance for corrective stress and increases pressure on institutions to respond quickly, even when restraint would preserve long-term credibility. Over time, that pressure accumulates. None of this implies imminent breakdown. Systems like this can persist for years, even decades. But persistence should not be confused with health. The absence of visible crisis does not mean balance has been restored. It often means imbalances are being warehoused inside institutions whose capacity to absorb them is finite. What makes this moment distinct is not the scale of intervention, but its normalization. When emergency measures become baseline assumptions, the economic system quietly redefines what is normal, what is acceptable, and what is possible. And once those definitions shift, reversing them becomes far more difficult than establishing them in the first place. This is why the issue matters over the next decade, not the next quarter. The question is not whether the system can continue operating. It clearly can. The question is whether it can still correct itself without relying on ever greater intervention to do so. That distinction determines whether stability remains a strength or gradually becomes a constraint. So the hidden cost of economic stability built on permanent intervention is not immediately visible in data releases or market charts. It is visible in behavior, in incentives, in the quiet loss of optionality, in a system that functions, but with fewer ways to adapt when conditions change. Understanding that distinction matters, because what looks like strength on the surface can mask fragility underneath, and what feels like control can gradually become dependence. Thanks for watching, subscribe, share this, and stay alert. Because what's happening beneath the surface right now matters more than most people realize.